Welcome back. You're watching Midday Prime. We return to our top story about the acquisition of the Silicon Valley Bank, SVB, by First Citizens and the role played by FDIC. To talk about this important event and its implications, joining us is Dr. Charan Singh, eminent economist and CEO, EGROW. Good afternoon and welcome, Dr. Singh. If you could first simplify for us the nature of damage control that we're looking at with the acquisition of SVB. And the role that FDIC is playing in this process.
This is one of the most amazing stories since 2008. When the Silicon Valley Bank went under, it was a very worrisome development that happened in the US. The interest rate cycle had started changing, and it had been changing for nearly a year now. Interest rates had really increased rapidly and tremendously. We all know how the Silicon Valley went under the belly, and it was something worrisome. Now this could have a contagion effect not only in America, it could have across the world. The whole world was worried whether this is now going to be a reputation of 2008, and one after the other banks would also collapse. The trend started. You know, Credit Suisse got into trouble, and you also know Signature Bank got into trouble. But then I think the American administration got up and said they need to quickly do some remedial measures and do it really strongly and do it really fast. Had it happened in India in 2004, there was a similar situation, the Global Trust Bank. India found a suitor and quickly sorted it out. In UK, again, the same thing happened. They quickly sorted it out. But in America, they took some time. What they have done is, I think, amazing. This is the Silicon Valley Bank, which is the 16th largest bank in America, which has a balance sheet of nearly $209 billion. It's substantially large, but it's a unique bank. It's not a commercial bank. The American administration, the government, the president swung into action and said they will make sure that the taxpayers don't have to bear the losses. It's the insurance company, Federal Deposit Insurance Company. They will take care of the losses. The Treasury, under the Treasury Secretary Janet Yellen, also announced a line taking care in case anything happens to save the taxpayer but help the bank out. Now, 2 weeks later, they have been able to find a suitable suitor, another regional bank, the First Citizen Bank, which will buy the deposits and loans of the Silicon Valley Bank. To that extent, the taxpayer will not have to pay. Losses will obviously take place. The First Citizen Bank also has taken nearly $72 billion assets at a discount of nearly $16.5 billion. The FDIC will also incur a loss, and they are planning, and their loss is estimated around $20 billion. The implication is, and I think it's a very important implication, right, that the taxpayer will not suffer. There will be continuity. From Monday, 17 branches of the Silicon Valley Bank will open as a First Citizen Bank in America. UK wing has already been sold, so that is different. To that extent, the market is happy. The market, as you were mentioning in your story, the market is now getting confident that the crisis has been taken care to a great extent. While the contagion is happening, the Deutsche Bank has come into some trouble, but the key thing is, as far as the Silicon Valley is concerned, the alert government, the alert regulator, the alert insurance companies have swung into action, and now after 2 weeks, stabilizing the financial markets.
Dr. Singh, as you mentioned importantly, that the taxpayers' money will not come into play as far as acquiring Silicon Valley Bank is concerned. But the larger crisis, in the crisis of confidence, if I may say this, in the banking sector, and of which Silicon Valley Bank can be seen as one symptom, is that crisis addressed with this solution? Is this a model? Is this the medicine that will work in other contexts as well?
Very good question, I must mention, and there's a lot of lesson to be learned from India. As I mentioned in the passing earlier, in 2004, you must have seen the plan B that the Reserve Bank of India had. Just on a weekend, there was a crisis. By Monday morning, the bank had been acquired by another bank, total continuity. So yes, there is confidence has been shattered. 2 weeks is a long time. The UK model, where they did it in $1 instantly, I think is the best model. So given this situation where the interest rate risk has to be factored into the balance sheet of the banks, I think regulators in America and other countries which have been raising the interest rate rather rapidly have to be aware that they have to have a plan B, plan C, so that if one fails, the financial markets don't get impacted. The point that you are making, the taxpayers' money, on the Wall Street and other stock markets, many taxpayers have lost huge amount just because the Silicon Valley, to that extent also it is the taxpayers' money. Janet Yellen, when she poured in $25 billion, it was obviously the treasury, that's also the taxpayers' money. So the question that you say is very valid. Now what needs to be done? I think the lesson that has to be seen is the regulator and the supervisor has to be very alert to stem the fall in the confidence, because confidence is shattered. As you know, it can travel. It did travel to a few banks. As I mentioned, Credit Suisse and Signature Bank and now the Deutsche Bank. It can travel, but this measure, this initiative, this last step of buying a bank to some extent will stem that. The interest rate cycle is rising. The pressure on the balance sheets of the banks is rising. So therefore, to stem that, the regulator and supervisor has to be very alert. The last point I want to make is, and I want to mention it in a very unbiased manner, these are banks which are on a different model. They're not standard commercial banks. Commercial banks in America continue to be steady. So I want to give that credit to their regulator, that to that extent they have been monitoring it. For the rest of the world, Europe and even India, I think we need to be very alert when the interest rate cycle changes. The balance sheets have to be very quickly monitored and ensure that which are the most vulnerable ones which could get under pressure, and then once any single bank gets into pressure, there's a galloping effect that happens. Other banks can also get impacted. Non-banking finance companies can also get impacted. So that has to be taken care of.
Right, sir. Also to understand the crisis in the banking sector that we're witnessing at present, any reference to a crisis in financial or banking sector takes us to the 2008 economic downturn that the world witnessed. In what ways is what is happening now different from 2008, sir?
Very good. Again, another excellent question, and I totally agree with you. That's the fear in the mind of the policymaker, the regulator, the scholars and economists, because the 2008 crisis was a very, very big challenge, and it took us nearly 15 years to come out of it, not yet out of it. What is different? Number of things are different. Firstly, the banks themselves have come under lots of regulatory framework and their capital adequacy ratios are far more robust. Risk assessment in the last 15 years has been very, very strong. Financial sector assessment programs across the world has been done. So with this, the banking system itself is very strong. As far as the regulator is concerned, the lessons have been learnt very clearly in 2008, and therefore the regulator and the supervisor both have been very alert and watching it. As you have just noticed in this case, unlike the Lehman Brothers, the government swung into action almost within 24 hours and stemmed the lapse in confidence. So I think that's the lesson very, very well learnt, that you can't leave it to the market forces. You have to quickly come in, take into people's confidence and then take remedial measures. So the government has also learned the lesson, the regulator and supervisor has also learned the lesson. As far as one more thing I would like to mention, the markets have also been very alert and started factoring it very early on if there is a risk, and the market has also been in a way pointing it out that these are the institutions which are vulnerable, and they start factoring it, and you can immediately, the regulator and the bank itself can immediately start seeing where are the vulnerable points, markets assessment, and quickly reach there with a band-aid and provide first aid and take care of the situation. So all the stakeholders have learned a lesson. Who has not learned the lesson? The rating agencies. The rating agencies even earlier and even now have not learned the lesson, and I think that needs to be taken care. I must give credit to the President of America, who said all stakeholders need to be held accountable. Even the top management of the banks need to be held accountable in which banks these crises is taking place. So we are evolving, we are learning, the regulator and the government, everybody is learning, and the system is getting more robust.
Dr. Singh, you mentioned earlier that the tighter regulation in Indian banks is for the world to take note of. But given the kind of domino effect that we've seen in economic crisis earlier, how should we in India be looking at these banking crashes unfolding in the US, in Europe and elsewhere?
Well, I must congratulate the Indian regulator and the supervisor. They never let something like this happen, and the last that happened in the Global Trust Bank, how beautifully they took care of it. Credit goes to the then governor, Dr. Y.V. Reddy. In the case of the government also, the way they have adequately provided capital to banks has to be really seen, how quickly they reach the bank and how quickly they provide them enough adequate capital so that there's no run on the bank. The most important thing I think for a bank is that they have to on their own do their risk assessments very, very carefully. There's a lesson to be learned from India. The lesson to be learned is, while the Western world used to teach us, I used to work at the Reserve Bank, they used to teach us that in case you regulate the banks very seriously, then where is the innovation going to take place? There's a trade-off between regulation and innovation. But in India, we always said we understand that, but it's public money that we are holding. So we really cannot allow too much of innovation to take place, because we have to take care of the confidence of the people. That is why in India, whatever products that we introduced in the banking sector, especially the derivatives, we did not get there because we weren't very sure if the Indian markets are ready for it. So the lesson to be learned is new financial instruments, financially engineered products, when they're launched into the market, they have to be very carefully seen, assessed, and after testing it, only then put it in the market. Exactly like the vaccines. How can you not test a vaccine and put it on the people? It can be very harmful. Similarly, financial instruments need to be very carefully checked, tested, and only then introduced into the market. That's the lesson which the Indian regulator wants to share with the world. That's what I think.
Right, Dr. Singh, and finally, we know that the health of the banking infrastructure is closely related to the health of the economy. And when we see recessionary trends in the global economy, in Europe in particular, how is that impacting the kind of challenges that the banking sector is facing, sir?
Well, I don't think much of a challenge as far as India is concerned. Very robust banks, economy is amongst the fastest growing in the world. Yes, we are not growing at 8%, we are growing at 6.1%, 6.5%. I understand that. To that extent, the banking regulator and supervisor in the banks and the boards have to be very alert, looking at the balance sheet of their banks, the flow of credit, and also looking at the risk assessment and the non-performing assets that could come up. Once there is a slowdown in the Western world, what is going to get impacted most for us? Our exports are going to get impacted most, and therefore we need to be alert. And that is one lesson which I think we have in India need to play, and we are under the G20 presidency. We have to tell to the world that major economies have a role not only for their domestic economy but a global economy. So they have to be responsible for their initiatives impacting the rest of the world, and they have to be held accountable for it, as President Biden mentioned. Now the issue is, when these countries raise their interest rates so rapidly, they impact the capital flows. And that's how they impact emerging markets. And if emerging, and we are all well connected, the world is flat. If they can't absorb our exports, our growth is not good. How are we going to absorb their capital and give them good returns? We are totally integrated. So I think every step that is taken by the Western or the important emerging countries need to be thought through. And who will think through? Who will help the platform? The World Bank and the IMF have to provide a platform where these things are thought through. Even the rescue packages are thought through. Even initiatives should be thought through, because the flatter world can otherwise harm everyone on the planet.
On that note, Dr. Charan Singh, thank you very much for joining us on Midday Prime and sharing those lucid insights on the SVB case.